The full disclosure principle was introduced in your early accounting principles courses, but this will look at it much more detail. The financial report should include any information that could affect decisions made by external users. This is the ruling by FASB. But there is an underlying constraint, and that is cost effectiveness. So sometimes you may not be able to disclose everything, although you are encouraged to. The full disclosure principle requires financial statements provide all material, which includes relevant information concerning the reporting entity. And this can be in separate disclosure notes or parenthetically on the statements. So focus on this as you proceed through future chapters, how things are allowed to be shown on your balance sheet and income statement and elsewhere to comply with the full disclosure principle. Disclosures convey additional insights about a company's operations, their accounting principles, their contractual agreements, and possible contingent pending litigations. Supplemental financial statements report more detailed information than shown on the primary financial statements. So the focus here is what goes into the disclosure notes and in what order. The basic rule, though, keep in mind, you will never get in trouble for disclosing too much by FASB. So what goes into them? Well, you will have the summary of significant accounting policies. You must disclose this. You'll have details of the financial statement items. So you'll have specific totals on your financial statements, but then the details of what those totals are have to be included. Any subsequent events, we'll talk about what that means. Noteworthy events and transaction, that's different than subsequent events. And then there's the MD&A, the management discussion and analysis, management's responsibilities. Then there should be an audit report. It is required for publicly traded corporations. And then finally, the compensation of directors and top executives. This is called the Proxy Statement. This is the order that it should go in. You may see corporations deviate from this order, although this is the recommended order it should be shown in the disclosure notes. That way, an analyst looking at many, many different corporations going through the disclosures, if it's in an orderly fashion, it's easier to track the information and compare the information from company to company. So first, the summary of significant accounting policies. Examples might be your inventory pricing and costing methods. Do I use LIFO? Do I use FIFO? What depreciation methods am I using? Am I amortizing the intangibles? How many years am I doing this? What are my choices? The completed costs versus the percentage of completion. This is advanced revenue recognition topics. The old methods, revenue recognition rules have changed or are changing in the next couple of years, and that will be discussed in the second semester of intermediate accounting. What goes into my cash equivalents? What does my company consider a cash equivalent? What are my specific revenue recognition policies and bad debt policies? What are my internal policies regarding consolidating financial statements for some of my subsidiaries? What are my internal control policies? This is very important. Now, the accounting policies do not include the actual dollar amounts. That's not a policy. Or the details of changes in accounting principle. That's not a policy. Specific dates of maturity of your long-term debt. That is not a policy. That goes separately. It goes elsewhere. How did I actually calculate the depreciation or the amortization expense? That's not a policy. So the details of the financial statement items, the next section, what are those numbers? This is where the breakdown goes for all these different items. How did I come up with those amounts? That's different than policies. And that's just an example of how if you show things in an orderly fashion, show the policies, and then show the details, it helps analysts understand what they're reading. Subsequent events, what is this? These are material events that occurred after the end of the year, but before the financial statements were audited and released. So let's say you have a December 31st ending fiscal year, your financial statements will not be prepared and released until at least March, because during that time, January, February into March, sometimes in April, depending on the size of the corporation, your financials are being audited. They have not been released yet. But if something happens during January and February and it will affect the company, then that is considered a subsequent event, and you may have to go back and make an entry to show what's going to happen. Noteworthy events and transactions. These occur rarely, but they are material. Let's say related party transactions, errors, irregularities. Now, related party transactions are not illegal as long as you disclose them. There's a key difference between related party transactions in the financials and related party transactions for tax reporting. For tax reporting, it's simply not allowed. You're not allowed to use something as a deduction if it was a related party transactions, but for your financial accounting, you can, as long as you disclose it. Unintentional mistakes, errors, irregularities, you want to think intentional. And illegal acts. Now, this may sound very strange, but the GAAP rule is, if I've committed fraud, I have to disclose it. Strange rule, but that's the fact. A very biased view of the company, but significant information about operations, that's what comes from management discussion and analysis, the MD&A. This also has to be disclosed. And management loves writing these. This is where they tell everyone how wonderful they are. Talks about their operations, their liquidity. So be very careful when you're reading this. Understand it's a biased view, but it can still give you a lot of information, especially about the capital structure. Do they finance mostly with debt or with equity? That's something that management often talks about in the MD&A. The responsibilities of management. This is tied to the audit report. What is the auditor responsible for? What is management responsible for? And they're required to make a statement and sign and attest to that. They have to also, since Sarbanes-Oxley, since the days of Enron, the new Sarbanes-Oxley rules, they have to certify that they have implemented effective internal control. Not only do they have to implement it, they have to test it annually, make sure it's still working, make sure the policies are still working. The audit report. So what is the auditor's role? They offer attestation services. And what does that mean? They're attesting, they're expressing an opinion of the financial statements. Are they in compliance with GAAP? The first line will always say report of independent, because the auditors have to be independent. And then there's paragraphs. This too must be shown in an orderly fashion. There is a template that auditors use. It shows the order of how things are presented on the statement. And when you review the examples in your text, you will see that. The key is auditors must be independent of the company, or they're not objective. Now, what are those opinions? Well, new terminology. Unqualified means it's a good. The auditor agrees it's in compliance with GAAP. If it's qualified, that means it's bad, but it's not too bad. Maybe just one or two areas. If it's adverse, that means it's a really bad audit opinion. And a disclaimer, that is no opinion can be given. Remember, unqualified is good. It does not qualify for further review. It's fine in the auditor's opinion. Now, for fraud, you would not give a disclaimer. You would not give adverse. You're required to withdraw from the engagement. You do not want to associate yourself with companies that you suspect of fraud. Unqualified, that is a good report. It's presented fairly in accordance with GAAP. It does not qualify for further review. There are specific rules governing audits. If you're dealing with a private company, the AICPA sets the audit rules. If you're dealing with public companies, the PCAOB and Sarbanes-Oxley govern those rules. It's the Public Company Auditing Oversight Board. The proxy statements, finally, the last part of your disclosures. This reveals compensation of directors and top executives, how much of those at the top are getting paid. Are there stock options or other compensation? This needs to be disclosed. It's important information if you're investing in a corporation. You need to know that. So, the summary of significant accounting policies. Let's do a little practice. Is it A, guarantees of debt to others? B, refinancing debt subsequent to the balance sheet date? C, adequacy of pension plan assets? Or D, the criteria for determining what is classified as a cash equivalent? So what goes in that category? Remember, the disclosures, it's not just a ton of information lumped together. It's presented in an orderly fashion. So of these four, what's an accounting policy and what is not? What would go elsewhere? It's not A or B. It is D, the criteria. That is a policy. The other information goes elsewhere into the details of the financial information. Looking at some more. What about management's opinion on future growth? Where would that go? Future minimum lease payments, basis of profit recognition on long-term construction contracts, or the depreciation expense. So what is a policy? It would be C. The other information is going to go elsewhere in your disclosures. Still has to be disclosed. Everything does. But it's certain things go in certain areas of your disclosure notes. It's very orderly. So what about these four? Revenue recognition policies. That's kind of a giveaway. Current year equity transactions. Schedule of fixed assets. Long-term debt outstanding. Of those four, the only thing that's going to go in that first section, the summary of significant policies, is going to be your revenue recognition policies. So that is a summary of the disclosure notes, what goes in them and how they must be presented.